Have you ever wondered how to save more tax dollars and put more dollars in your pocket? Let's find out more about flow-through shares today on Money Match. Hey, welcome back to Money Match. It's Ian Ardill here. I'm joined together with Dan Pembleton, who is the president and owner-operator of Accilent Capital. And he's here today to talk to us a little bit about one of their premier funds, Pavilion. And Dan, thanks so much for joining me.
Great to be here, Ian. Appreciate it.
Dan, just really quickly, for those who may not have watched some of our conversations in previous years, wondering if you can just give me an ever so brief overview of what is Pavilion and what does it do for its investors?
Sure. So Pavilion is a junior resource fund. That's the sector that it invests in. And it has a big benefit in that the investment that you make into the Pavilion fund is fully deductible against your income in the year in which you invest in the fund.
So much like an RSP.
Very much like an RSP, but with a few better tax benefits, actually. So one, I said, fully deductible. Over the life of a flow-through fund, you get about 115% plus total deductions against your income, with 100% of that roughly coming in the first year, maybe a bit more. And the other part of it is, which is different from RSPs, is when money comes out of the flow-through fund, you're only taxed as a capital gain, instead of having it being added back into your income like it is with an RSP. So it's a very big tax benefit because it changes the nature of the tax that you're paying from your very highest rate to the capital gains rate,
which approximately is half of whatever that rate would be.
Well, that's correct.
Fantastic. So, and then, talk to me a little bit about the investment. But something that you've said to me previously is that you are an investment first, a tax vehicle second. And so there's these amazing tax features that are indicative of almost every flow-through share done correctly in Canada. Mm-hmm. But I think what defines you guys a little bit different and makes you incredibly unique in the Canadian marketplace is that you really have an investment first focus. Tell me a little bit about that.
Sure. It all started when when I was looking at how other investors, some very elite investors in Canada had made a lot of money investing in junior resource companies, and they were doing it without the tax benefit. So what were the activities that they were doing? And I designed the Pavilion fund to be an investment first rather than a tax vehicle. So I took what I felt were the most applicable and best attributes of what those investors had been doing in investing in junior resource and put it into a fund that has a tax benefit as well. So the whole premise started with, how do I make this a great investment? How do I make this something that where people could put money in beyond I get a tax refund, which is not the best reason to make an investment. If that's your first reason, that's not the best reason. So we made it an investment with spectacular tax benefits. So we look at it as, we've got this fund which is designed as an investment, and you get roughly half or more of your money as a tax deduction right off the hop. So it makes it a very low entry point into Canadian junior resources.
Fantastic. So, roughly, if you think about a time horizon, describe for me, if someone cut a check and invested into Pavilion today, what kind of time horizon might they experience on that investment?
Sure. And this is impacted, by market conditions. Obviously, again, as a fund that's there to make money, I like to, like to buy low and sell high. So there are some market impacts on that. We can't go, the funds don't go any longer than 5 years. We set that as its longest terminal date. However, what ends up happening, because we're managing the fund on a day-to-day basis, is we're constantly looking for opportunistic and profitable exits. So if you look at what the designed average time that your dollar will be out is, we're looking at about 36 months, 3 years. And that doesn't mean that all your money comes out at 36 months. We've had funds where we've sent money back after 6 months, and we send money back, at regular intervals all the way along. It tends to be a little less in the first couple of years of the fund, and ramping up to higher amounts right around the 3-year and 4-year mark. And then the 5th year is kind of, when we clean up the balance of the fund, or we've got investments that are running particularly quickly, we want to let them, continue to create value, where we'll take them out on the 5th year. So when you buy a Pavilion fund, you can expect small distributions along the way. There's no set schedule, so you may or may not get one in the first year, but you'll find that, year 2 out, you're getting checks back, with the biggest checks coming in sort of the 3rd, 4th year of a fund's existence.
And in terms of performance, one of the things that I love about your structure, Dan, is that it's really, on the Canadian landscape, you have the historical best return on any flow through fund in Canada, on a singular fund, and your average is much higher than any other Canadian offering in this landscape. Is that a correct statement?
It is. Yeah, that is. Those are both correct. And this is not, again, this is not impugning the ability of other managers to manage their funds. What and hopefully they're not watching, because the secret sauce of Pavilion is that what it does is it allows the manager, in this case being me, to use all the tools in our toolkit in order to create value for our investors. So by structuring, and again, it goes back to, watching what the investors who made a lot of money in this sector were doing, saying, okay, this is what we need to do, and then add the tax on top of it. Whereas other funds, when they were structured, they're like, oh, this is a great, we'll just do this, and we'll do tax, and that creates, it really puts their managers into a very small box. So basically, I've expanded my operating box, so I can sell or not sell at any particular time, which allows me to take advantage of higher prices on stocks, if, as and when I see it happening. And I don't have to sell the whole fund, because, as we all know, just like, all apples on a tree don't ripen at exactly the same time, all stocks don't meet their best selling point at the same time in a fund either. And basically, my fund structure allows for that to happen, and I can take advantage of that.
Yeah, and I love it. I love it. I want to speak to two really brief things that I think you're highlighting, or maybe you're just scratching at. You are the author of this fund design, so I'm grateful to be hanging out with you. You're a little bit of a rock star in the flow through share space, but you're also backed up by an awesome team. Fair? In a God forbid scenario, if you weren't in the picture, it's not, you refer to your fund, but, and I love that, because I know that you're a very heavy investor personally in your own fund. You take ownership of your fund, but again, at the end of the day, you've got a team around you that could operate the fund in theory if you got hit by a bus. Is that a fair statement?
Absolutely. Yeah. It's, and again, it's like I say, our biggest secret sauce is our fund structure. Not necessarily the portfolio manager itself. So again, it's like, we can put people in place in this really good structure for creating wealth in the Pavilion Fund, and others can operate it. And certainly that's a big push for me always, and always has been, is to make sure that the people around me, my analysts and associate portfolio managers, other portfolio managers in the firm, are all well versed in what we do, so that if anything ever happens to me, it won't happen. Nothing will happen to the fund. It'll carry on without me, obviously with a tear in its eye, of course.
Well, Dan, I know you're not planning to go anywhere right now, and I'm grateful that you're a wonderful operator and a great business partner. So, yeah, just flipping gears there. You also really spoke to the value of the fact that there's multiple things in each fund. So I'm wondering if you can speak to this idea of diversification within your actual deployment. Like, are we, if someone makes an investment in Pavilion, how many holdings might they have in any one given fund? Can you talk to that? Speak to that.
Yeah, sure. It can vary from year to year, but you'd be looking at roughly 30 to 40 different holdings within a fund. There will be certain ones that will have very significant weightings, say as much as 7% of the fund for ones that we are particularly confident of and meet our risk characteristics and liquidity characteristics, and down to others that are 1 to 2% of the fund. And every, as I like to say, every holding within a fund has a job to do, and it's not always the same job. So that's why diversification is important, because again, we're not as portfolio managers, we're not all knowing. So our idea is is to make our best calculations of what we think is the best mix. We might lean one way or another in certain environments, and then make sure that we have all as many other characteristics covered off with our diversification. So certainly the first one people might think of as diversification between different commodity types. So copper versus precious metals versus uranium or something like that. But also in the junior resource sector, there's a spectrum of exploration, from very greenfield sites to very mature exploration, and there's different things being done there, and they all offer different opportunities and rewards and risks. So you want to create a portfolio around that, as well as geography within Canada itself. So you want to look at different regions and try and be represented in as many different ways as you can.
Thanks, Dan. And one of the strategies that you guys have talked a lot about is not just diversifying within any given fund, but also diversifying in terms of your annual funds. So this becomes a part of somebody's annual tax planning, so that every year that they invest, they might own similarly constructed portfolios, but ultimately those portfolios will behave unique to themselves. Is that a fair statement?
That is correct. That's right. They take every portfolio has a different starting point, and obviously a different ending point in terms of time, and that also means they'll have different weightings and different entry prices, because, you know, predicting stock moves is difficult business. And so I
Why didn't
think,
you have a golden ball, Dan?
yeah, I know. I guess even
I don't know.
I'd still be talking to you, Ian, but if I had that golden ball, I would just be so incredibly wealthy.
Or your golden, sorry, crystal ball. Yeah, sorry, I'm using the wrong phrase,
Okay.
but yeah.
Yeah, well, golden egg, crystal balls. I mean, it's all in the same family. But yeah, because we're not perfect predictors of
Dan,
stock.
I used to be a pastor, so I've got a divine connection, right? So
Oh, you should can you join my investment committee? We can
yeah.
help use that extra edge.
Hey, well, listen, let's shift gears.
Sure.
In terms of total return, based on your audited November 30th statement, you shared with all of your investors that your total return, on an average of all of your funds was 27.5%. So if someone invested from fund one to fund your last fund, you'd be sitting around a 27% return from a total return basis. But if you add in the tax aspect of it, you're sitting at 118% return. That's buying all your shares at a $10 price. I sit in that statement of 118% return after tax, and that's profound. There's so much value in that statement. I don't know if you have any comments on that.
Well, yeah, absolutely. I have lots. Certainly I'm the one I'm most proud of is obviously the 27% total return. The reason being is that's a cash on cash total return. That means that we, over the last 15 years, have been buying baskets of junior resource companies, and on average, exiting those baskets 27% higher than we entered them. And that's hard to do because it's, junior resources, as if anybody looks at it, is a challenging area, is highly volatile, which is why the flow through program exists. So that tells me that I've done my job and that I've created some value for people over and above the tax. And then when you add that tax in, then that just, in my mind, has made it an excellent wealth builder for people, which is why, and also over, because it is over a period of time, we're measuring the average over a number of years. That's why we always advocate, trying to the greatest extent possible, try and be as systematic and in the market as often as you can, because the effects of being able to have the diversification of multiple fund years in your portfolio is very helpful, and that helps to unlock that total return number, so you're more likely to be closer to that by being consistent with it.
So Dan, I think one of the statements I've heard you describe is the time is now. The time to buy is very, very accretive at the moment.
Yep.
And I want to quantify that a little bit. We've, in previous episodes, if you look at some of our other episodes that we've posted on YouTube, we've talked about this Supercycle, where there's a commodity need or demand out there where there just has been a lack of resource investment in the mining space. And therefore, the price tag on a lot of commodities has been going up. But all of a sudden, it's this really weird. We started seeing major jumps in 2019 and 2020 and 2021 even. But starting in 2021, we started seeing a softening in the market. And yet the demand is still increasing, right? So we have this demand going up, but a softening in prices in 2021 and 2022. And so I'm just wondering, we're saying that there's a super cycle demand Can you speak to that, Dan?
Sure. So, well, what happened is when you look in, particularly 2022 is the soft year that we're talking about, and what happened there was the Fed raising, and all central banks, particularly, were starting to raise interest rates. The Fed, the biggest and quickest of all of them, and what ends up happening is the standard playbook, investment playbook is, okay, Fed raising interest rates that fast, chances are there will be a recession following that, or some softening in the economy. What do we do in a softening economy? Oh, we sell our commodities and we buy, long bonds. So that was the kind of thing that was going on. And, we had a major bear market in the broader markets as well. So that just generally puts some risk off pressure on things. And what it doesn't do, though, is change the long-term supply deficits in commodities. So this was more of a shorter term trading, kind of reshuffling of risk books. And what happens is, and creates an opportunity, is that because it hasn't changed the long-term supply and demand dynamics, which we are in a super cycle, which means demand is going to consistently outstrip supply over a period, over a medium to long-term period, that as soon as people see that the economy is coming back, kind of in the middle of a coming recession, or they see that the recession isn't going to be as bad, then things bounce back very, very quickly. People will be back into the commodities. So what this gives us a short-term opportunity on the investment side for commodities to pick things up very inexpensively a couple of years into a commodity super cycle, which is very fortuitous for all of us who are in this space, because we're buying stocks much cheaper than we would expect to be able to do in the third year of a commodity super cycle. So that's why it's happened, and that's why we think we have a great opportunity here.
So the old adage of buy low, sell high is certainly applicable here. Yet our hearts, our emotions, when they get to us, we oftentimes sell low and buy high. And so what you're telling me is, for those that have maybe bought the last 2 years, and again, it's not bad results, but it's a little bit softer results than what one would otherwise desire. Sure. What I hear you saying is you're quite confident that those are going to be sitting in reasonable positions moving forward, and that right now, from a new investment dollar perspective, you see some really, really positive buying opportunities. Is that a fair statement?
Absolutely a fair statement. You could say, keeping in mind we've been doing this for 15 years, we've seen some soft markets before, and we've had people who maybe have invested for a couple of years, and those are kind of going sideways, and then you get into the third year of your investment, and you get this kind of an opportunity, and this story has played out in our funds many times before, and you need to keep an eye on the long-term results that we've had, and still looking forward, does this make logical, fundamental sense? And I think if you look at both of those, you're like, yeah, that makes sense, which is why we always talk about the consistency of investment. This is exactly why you do it. It's like, if you invested in 2020 or 2019 or even 2022 as a starting point, and you told yourself, I'm going to do it for 4 years, 5 years, or I'm adding this to my tax management program, keep doing it. The path is not indicative of the final result, and that we've shown that on many of our funds in the past. We've had funds that have dropped down in value and then exited at a multiple of what investors had initially paid. So it's not indicative. Yeah, it's more programmatic is the important part.
Dan, thank you for your time. Obviously this is not an individual investment suitability statement, but the time is now. Generally speaking, the time is now to buy some fantastic buying opportunities. So appreciate your insights. Thanks for joining us here on Money Match. And I will look forward to talking to you real soon.
Thank you very much, Ian. Appreciate it.